The Federal Reserve's decisions have long been one of the biggest drivers of market movement, and as potential interest rate cuts loom on the horizon, many investors are left wondering, what does this mean for the health of the U.S. economy, and how will markets react? To understand the potential effects, we first need to take a closer look at why the Fed might consider cutting rates in the first place. Interest rate cuts by the Fed are generally a response to slow economic growth or a recessionary threat. The idea is to make borrowing cheaper, encouraging businesses to invest and consumers to spend more. In theory, this stimulates the economy by driving demand, leading to job creation and wage growth. But there's another side to the story. Cutting rates too aggressively, especially when inflation is already high, could lead to overheating the economy, which in turn drives inflation even further. This brings us to the current economic environment. Today, we are in a bit of a unique situation. Inflation remains a concern for the Federal Reserve, even though it's come down from the peaks we saw in 2022. At the same time, growth has slowed, but not collapsed, and the labor market remains tight, with unemployment at historic lows. The question now becomes, is the economy strong enough to handle more rate cuts? Or will they simply exacerbate the inflationary pressures? The Fed has already raised rates significantly over the past year to curb inflation, but those hikes are also making it harder for businesses and consumers to borrow. That slowdown in borrowing leads to lower investment and spending, which could cool off economic growth. So what happens if the Fed does decide to cut rates? Much of that depends on the underlying health of the U.S. economy. If the economy is indeed resilient, as some indicators suggest, then rate cuts could fuel a new round of growth. However, if the economy is weaker than expected, rate cuts might signal deeper trouble ahead. Market sentiment often reacts more to the Fed's signal than to actual economic conditions. Investors might see rate cuts as a sign that the central bank is worried about future growth, causing volatility in stocks and bonds. On the flip side, if investors believe the economy can weather the storm, rate cuts could boost confidence, driving up asset prices. This uncertainty creates a tightrope for the Federal Reserve to walk. Too many rate cuts, and inflation may pick back up. Too few, and the economy could slow down too much, potentially sliding into recession. Stock markets tend to react positively to rate cuts, at least initially. Lower interest rates mean cheaper borrowing costs for companies, which often leads to higher corporate earnings and, in turn, higher stock prices. However, it's important to note that the initial rally in stocks may be short-lived if the underlying economic data doesn't support sustained growth. If the economy weakens or inflation remains high, markets could see increased volatility. Investors may adopt a more cautious approach, focusing on sectors like healthcare and utilities, which perform better during downturns. The bond market, however, directly responds to interest rate changes. When rates are cut, bond yields fall. While lower yields benefit current bondholders, they can be less attractive to new investors seeking higher returns. A faltering economy may increase demand for safer assets like government bonds, driving prices up and yields down. The strength of the U.S. economy, including consumer spending, job growth, and corporate earnings, will ultimately influence market reactions to potential Federal Reserve rate cuts. Global factors such as geopolitical tensions and supply chain disruptions also play a role. A weakening global economy could impact U.S. exports, complicating the Fed's decisions. Other key indicators like inflation, unemployment, and corporate earnings will also shape the markets. Investors should diversify and focus on long-term strategies to mitigate risks. Whether the Fed cuts rates or holds steady, the U.S. economy's health will be the primary factor in determining market direction.